The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A Sell America downgrade Friday flips to a buy the dip moment here on this Monday. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Alex Steele. I am very surprised by the market action as we head into the close today.
What exactly do you mean?
What market action?
By you people.
Right.
What?
What are you talking about? Anyway, I'm surprised by the lack of market reaction that we're seeing here. So the S&P is completely flat. We are obviously down in the futures market as yields shot higher, particularly on the back end. And now we reversed all of that. It's like the last 72 hours just didn't happen. The S&P flat. The VIX still around 18. The 30-year yield now flat on the day. We hit 5 earlier, the highest level since 2023. The one outlier, where there's two, we'll get to the second in a moment, but the one outlier here is spot gold, still up by over 1%, as questions as to the U.S. credit rating continue to be in play.
Absolutely. It's kind of interesting, too. We want to talk about that correlation between treasuries and equities because it is important in the price action that we're seeing today. The spike in yields on Sunday night, that really did contribute to the sell-off that we had at the start of Monday morning. But as those yields drifted back into the pocket by midday, the equity dip buyers really did come out and retook the wheel. Michael McLean and his team over at Barclays, I thought, put it best, saying that government debt downgrades have actually lost political significance after that S&P cut back in 2011 led to limited, if any, repercussions. That seems to be the mindset for a lot of folks today, but not everyone else feels that way. Jim Milstein over at Guggenheim Securities and Steve Zellin over at PJT Partners saying that the shot across the bow from Moody's is still a reminder that budget deficits do matter and no meaningful attempt to rein them in will just compound into even higher borrowing costs, higher inflation, and ultimately, in their words, lower economic growth. Now, Fed officials today were peppered with questions about that prospect and emphasized the wait-and-see mantra that they've been touting for weeks. Vice Chair Philip Jefferson saying monetary policy can remain patient. New York Fed President John Williams agreed, saying we may need months to get a better understanding of the economic outlook. And we just heard from Atlanta Fed President Raphael Bostic signaling unwillingness to react too quickly. Alex.
All right. Well, let's get to what I was talking about in terms of the different asset classes. And this echoes on Romaine's buy the dip moment. So you saw gold adding to its price action today. What you didn't see was the dollar. The dollar continued to slide off the lows, but nonetheless. And that shows kind of the why. So the yellow line is the 30-year Treasury yield. So line goes up, prices go down. The blue line is the Bloomberg Dollar Index. And what we've seen is a real divergence between the two, which basically means that bonds and the dollar are selling off together. So what does that mean? Is that a re-rating of U.S. assets? Is that a lack of confidence in U.S. assets, which makes the rally in the equity market or the sustainability of the equity market very confusing? Morgan Stanley was saying that the 10-year yields continued to hover around those 4.5% level, and that's a very key level for market valuation in terms of the equity market. So we're on the verge, Morgan Stanley says, of having increased sensitivity from yields to the stock market, Romaine.
All right, well, let's kick things off here on this Monday afternoon with Mike Contopoulos. He's Deputy Chief Investment Officer at Richard Bernstein Advisors. And Mike, let's get right to it. Of course, Friday night, I think a lot of people saw that downgrade by Moody's and thought the worst. We had time to digest it over the weekend. And if you look at the price action today, I think the market has pretty much given us a vote as to what they think about it.
Yeah, I think that's right, Romaine. The market has given us a vote. And quite frankly, I mean, this wasn't really news. I think we've been talking about the fiscal situation in the U.S. for several years now, and how it's not in a great spot. And quite frankly, the U.S. has really sort of required a higher risk premium or higher yields relative to the rest of the world since that downgrade in 2011 that you mentioned just a few moments ago. I would actually argue there has been a structural change since that first downgrade. If you bring up the chart of the Bund versus the 10-year, for example, the U.S. 10-year, you'll see that has grown, that yield differential has grown in the last 14 years, and a lot of that has to do with the fact that you need a higher risk premium to own U.S. Treasuries today. So
when we start to talk about maybe an additional risk premium built into this market, and that seems to be the consensus, just not necessarily there's going to be anything extreme, what does that look like to you?
Well, I think it means a number of things. One is that's going to be hard for risk to rally meaningfully for any extended period of time. I think, if nothing else, there's just clearly a degree of uncertainty in markets. And this does not help. You have obviously the uncertainty around policy. Now you have the uncertainty around the creditworthiness of the United States, which again, we already knew about. And so it's not surprising to me that today you don't get a big reaction. But if you have this coupled with tax cuts, coupled with higher than expected inflation, coupled with declining earnings growth, to me, it just creates an entire environment of more uncertainty. And then there becomes a scarcity value to certainty. I think that's sort of as I look out over the next 6 to 12 months, that's going to be the big theme amongst markets is where can I get certainty?
I also loved how you called for your own chart. So next time we'll be more on that. Can we be in an environment, though, where we see the dollar, the bond market continue to sell off and equities hold up?
It would be surprising to me to see the bond market sell off and equities hold up. I think almost, it depends on how that happens. If it comes with a lot of volatility, you would expect equity markets to fall. You'd expect credit spreads to widen, particularly if that's happening at a time of declining earnings, which obviously equities and corporate credit are highly sensitive to earnings as well. So that would kind of be like a version of 2022 in a lot of ways. You had higher rates, you had falling equities. On the other hand, of course, if you have falling treasuries, you also could have falling equities because of what that would imply for growth. So, I could see both scenarios, and quite frankly, you probably have one before the other. You probably have a period of positive correlation where both rates are going up, right? And stocks are going down, and at the same, and then that sort of leads to the negative correlation in the future.
So where does that leave the credit market, particularly investment grade?
When I look at investment grade credit, there's just not a whole lot to like, quite frankly. Spreads are just too tight. It's not really that the fundamentals are so bad. It's just that there are better options out there. For example, why would I own investment grade corporates when for the same yield I can own agency mortgage-backed securities with more spread tightening potential in a government guaranteed instrument? That, to me, is sort of the relative value proposition that investors can make a choice to every single day. And if I'm presented with that choice, why own corporates? Spreads just don't compensate you for. We're very big at RBA into earnings. And spreads don't really compensate you for declining earnings growth when you can get the same risk profile, the same return profile elsewhere.
Are you still of the belief, though, that we are going to see meaningful decrease in earnings growth this year?
Meaningful, yes, but not sort of toe-curling recession. Let's put it that way, right? I don't think we're at the point where we're hiding under our desks in the fetal position or anything of that nature. But if you're looking at high single-digit earnings growth in Q1, which is where we think you'll end up, you probably are looking closer at 0% earnings growth as you look out towards Q4. But remember, markets trade on direction, better or worse, and so. It's not that the absolute level of earnings is falling off a cliff, but rather that the earnings growth is declining.
I am curious, though. I mean, if you go through the Moody's report, they do make some very salient points, and I understand this is stuff that's been litigated now for years, if not decades. But they do kind of point out this idea that we still have not seen the full impact of the tariffs. They kind of point to September and beyond as maybe being that sweet spot where we'll start to see the whites of its eyes. I am curious if that is an event that you prepare for, or do you just wait till it shows up and then try to assess what the damage is, if any?
Well, so I think it's an event that you can sort of prepare for, but what I would say is that you don't have to wait because we already have a lot of data, right? So we know earnings peaks the earnings peak was in Q1. So earnings growth is declining. We know that inflation is not at 2%. The Fed has indicated they're not in any rush to cut interest rates, right? So right off the bat, you're already, and valuations are still pretty lofty given the rally back in equity markets and the rally in spread products. So you've got pretty rich valuations in the context of tight monetary policy, and you've got declining earnings growth. So just that alone, absent tariffs and the effects of tariffs, you should probably start increasing certainty in a portfolio and quality and defensiveness. Then you throw in the impact of tariffs and seeing the whites of the eyes of what that might mean for growth and inflation. And you don't need to wait for that. You're already prepared for it.
So that setup, right, makes me want to go buy treasuries. But treasuries are then now sort of a worry asset. So where do I do that?
Well, I think it's where on the curve you buy them. So you probably don't want to be over-levered to the long end of the yield curve. There's going to be an inflation premium, I think, built into the long end of the curve. I think the belly of the curve, more in the front end, makes a bit more sense. I think agencies, because of that spread compression, compression potential also makes sense, and that spread cushion. But you're going to be for right now, you're going to be in a little bit more of a relative game performing from a relative basis versus, say, the Bloomberg Ag. And then that should ultimately bleed into an absolute return environment where treasuries do fall as growth falls. But, I think that's going to be probably later in the year, maybe even into 2026. And between now and then, it's about how do I outperform?
All right, Mike, great stuff. Mike Contopoulos, Deputy Chief Investment Officer over at Richard Bernstein Advisors, kicking us off to the close here on this Monday afternoon with the focus all day long here on the fiscal situation of the nation at a time when companies are quickly trying to find ways to reshore facilities back here to the U.S. A conversation up ahead with America's factory whisperer, Didi Caldwell, coming up in a second.
All right, speaking of reshoring, we're going to talk to the CEO of Carrier, one of the many companies planning a new massive investment in America. How Gitlin plans to invest $1 billion in the U.S. over the next 5 years.
And keep an eye on the big banks. Those stocks been under pressure all day long. JPMorgan, well, giving a little bit of a warning about where it sees investment banking fees going. And it's not up. That's coming up next here on The Close. This is Bloomberg.
So much of our economy is based on faith that we will deliver on the things that we say that we've promised for the future. When you start to see the markets waver a little bit, I think people are asking the question, do we still have that same level of faith? I think the sign that rates have started to come back down and the markets are sort of returning back to a normal stasis suggests that they think there is that likelihood moving forward, and we'll just have to see where it goes.
That was Bloomberg's Michael McKee interviewing Atlanta Fed President Raphael Bostic just moments ago at the Atlanta Fed's 29th Financial Market Conference in Amelia Island, Florida, explaining how the recent Moody's downgrade could affect U.S. rates. And that's where we find Mike. Mike, what was your biggest takeaway from this conversation when it comes to that Moody's downgrade and what uncertainty that might then mean for the Fed?
Well, he seemed to think that at this point, the markets are relatively well priced. And so it suggests that unless we see some additional movement beyond what happened today, it isn't going to change what the Fed is going to do. And it probably isn't going to change the economic outlook all that much because markets are already setting a price for things like mortgages. And if that doesn't change, if the 10-year yield doesn't go up much further, the impact on the economics going forward isn't going to be that great. Now, that doesn't change anything about what the outlook is under tariffs and the new budget plan, but at least with Moody's, it may not be a huge issue.
I'm curious, though, about that economic outlook, Mike. I mean, we heard from other Fed officials earlier today, including Williams, Philip Jefferson, and I think one other person. And the message seems to be clear here is that they don't really have that clarity. And I am curious what Raphael Bostic had to say specifically about when the Fed might feel a little bit more comfortable about wading into that outlook.
Yeah, you're hearing uncertainty from all of these other Fed people. Raphael and I talked about, let's try not to use that word. But it is the base case for everybody at this point. Nobody knows what's going to happen. And his view is that under the timetable that we seem to be operating on, it could be 3 to 6 months. It could be the fall, September or beyond before the Fed has enough information to decide that it has to do something. Remember, one option is they don't do anything. So it could be quite a while. On the other hand, he said if the president comes out and changes this whole timetable, then it could be something that happens much sooner. If he comes out at the end of the 90 days that we're under for reciprocal tariffs and just says this is what we're going to do, then they might have a better idea before September of what might need to be done.
I mean, at least this time we're getting like a 3 to 6 month window. So that feels a little different than we were even just a few weeks ago. Did you get the sense that Fed officials are more concerned about inflation or growth?
Well, most of them will say they're more concerned about inflation because growth has been relatively strong. We've still seen, despite a weaker retail sales report, people are still out buying stuff. And the unemployment rate has stayed locked in 4.2%. So right now, the danger seems to be on the inflation side, but all that could change very quickly. I spoke with one Fed official today who said they're locked in on the idea of the jobless claims number. If that starts to move significantly, then that would tell them that things are starting to fall apart on the employment side of the mandate, and that's something they would have to pay attention to. But for right now, as President Bostic was saying, at this point, it looks like companies are going to be holding on to labor because they just don't know what to do. The issue comes up when they have to make a decision. What will that decision be?
All right, Michael McKee down there in Amelia Island, a great interview that just occurred there with Raphael Bostic, the Atlanta Fed president. We continue our conversation right now here in Studio 2 in New York with Stephanie Kelton, one of the great minds in economics. She's a professor of public policy and economics at Stony Brook University. And Stephanie, I want to get firstly your reaction to the downgrade on Friday. I know this was a long time coming, given how long it was on negative watch, given the moves by S&P back in 2011 and, of course, Fitch in 2023. Do these ratings companies still have any sort of sense, I guess, of trying to be ahead of the curve rather than just, as Scott Bessent and some other folks in the administration have said, not just being the lagging indicator, if you will?
I mean, I know a lot of people are saying it was a long time coming. I actually had a piece that I put up in February, I think on February 3rd, and I was saying then, where are the ratings agencies? But it wasn't about the fiscal picture, which we've known about for a very long time. And I really don't think that's the job of the rating agency to opine on the fiscal trajectory per se. It's about credit risk and the risk of a credit event. And what we saw in the first 30 days of this administration was, from my vantage point, sufficiently worrying that I wrote a piece and said, why aren't the ratings agencies weighing in? I'm talking about the highest ranking career official at the Treasury Department walking away from his job because people from DOJ essentially infiltrated the Treasury and took over access to sensitive Treasury payment systems.
Right.
And at that point, it became a question of, impoundment. Are we going to spend as Congress has instructed? Are these young men running around with access to a payment system where they can turn payments off, including potentially payments to bondholders? So if there was ever a moment to step in and say, look, in light of concerns about a breakdown in governance, which is what Fitch cited when it downgraded most recently, a breakdown in governance, that to me looked like a very serious breakdown in governance, and yet the ratings agencies were silent.
Was there any sort of parallel, though, to what we learned if you go back to 2011? Because there was also a lot of criticism by the Obama administration at the time of why the S&P decided to do it when they did. Again, looking at the budgeting process going through Congress, and they cited a lot of the same things you're citing, this idea that there was just a disconnect and a sort of uncohesiveness to what was happening in the governmental process that they categorized as credit risk. At the end of the day, though, we never stopped paying our bills, and we never stopped paying them on time. And I'm wondering, why should I think this time would be any different?
Well, I think that, where there is legitimacy in terms of weighing in on some of these things, if you've got a Congress, even if it's just a handful of players, it can be enough to call into question the full faith and credit of the United States government on a willingness to pay basis. In other words, if Congress starts playing around with the debt ceiling and saying, well, maybe a default wouldn't be that bad after all, that sort of kind of thing, that is a real cause for concern. And the ratings agencies ought to come in and they ought to do what needs to be done to put investors on the right side of this, to say, hey, there is a legitimate chance here that you could see a credit event, a voluntary default. But they need to distinguish between a willingness to pay, which is what they were talking about then, and an ability to pay.
I mean, Moody's did point out, it's a little tangential, but the constitutional separation of powers needing to continue. That was cited as one of the reasons and one of the risks that the U.S. could go down. What should the credit rating be then for the United States?
Well, the credit rating for the United States should be AAA. I remember Warren Buffett years ago
Despite all the risks you just talked about.
Well, when you say the risks I just talked about, I don't mean a breakdown in terms of a president who likes to tweet or lean on the Federal Reserve or something like that.
A willingness to pay bills.
I don't think, I'm restricting my commentary to the willingness to pay. If you're messing around with that, there is a legitimate reason for a ratings agency to put investors on notice and to say you might want to be very careful in this moment. But we should be talking about ability to pay. And on those grounds, there is no risk. There should never be a point at which you question the United States government ability to pay its bills on time, in full, in perpetuity, given that every promise that has been made is to pay US dollars to someone. And because the US government has a sovereign currency and all of this debt is denominated in US dollars, there isn't an ability to pay question.
Right. We just like to play chicken with it, I guess.
Yeah, I mean, both sides, and to maybe a lesser extent with one political party, but both sides like to talk. Both sides are using this downgrade opportunistically right now, right? One side is saying, hey, did you see what Moody's just did? We need to go deeper with our spending cuts. The other side is saying, hey, did you look at what Moody's just did? You need to bring us in. We're going to exercise some leverage here. The Democrats would like a seat at the table rather than having Republicans do this through reconciliation where they run the entire show. So, I mentioned Warren Buffett a moment ago. There was a time when the ratings agencies downgraded U.S. Treasuries, and Warren Buffett said, this is crazy. He said, if I could, I would give it a quadruple A rating, and that's the way it ought to be for the United States of America.
Is that on a relative basis or on an absolute basis for the U.S., meaning are you looking at it through the lens of the U.S. relative to Europe or Asia or Asian countries, or is it just the absoluteness of where the U.S. stands?
Well, look, with Europe, we saw what happened. Europe actually did experience a debt crisis in the early 2010s. But these are a group of countries that stopped borrowing in sovereign currencies and started issuing debt denominated in what's effectively a foreign currency, the euro. So Greece, Spain, Italy, you remember these countries that became known as the pigs. Well, it was legitimate to have credit risk become a thing because there was a real chance that these countries were going to find themselves in a situation where they had payments coming due in euro and they didn't have the ability to make those payments. It wasn't a willingness, it was a legitimate ability to pay. So there is a distinction there.
But on that distinction between willingness and ability, you do have an administration that has given some lip service to this idea of potentially restructuring U.S. debt, this sort of Mar-a-Lago Accord, which is still a hypothetical, but certainly something that they are legitimately talking about. It's in Project 2025. And I mean, the consensus is that if they were to follow through on that, that in effect is a technical default.
I agree.
It may not be characterized like that. What does that do? If we do get to a point where we are having serious negotiations about refinancing effectively into longer term debt, then does that mean Moody's is right? Or does that mean maybe they should downgrade us again?
Well, not on the grounds that there is some desire to maybe move into longer term debt. I mean, you have to be a little more specific about what you mean there, but I know what you're talking about. And to the extent that what is being discussed and potentially proposed is something akin to a kind of soft default of a kind, then I think, again, there is a legitimate space for the rating agencies to come in and talk seriously to investors about the implications of that.
Before we let you go, you were pro the 2017 tax bill. You're not now.
Well,
the extension of the tax credits.
I wouldn't say that I was pro the 2017 tax bill. What I was not concerned about the 2017 tax bill for the reasons that many of my economist friends on, let's say, on the Democratic Party were concerned. They were concerned about things like, increasing the deficit by too much, driving up interest rates, crowding out, slowing the economy. I said, this is not the stuff that would concern me. What would concern me is the inflationary risk associated with that bill, which I considered to be really low at the time. Now it's different. Now it is very different. We have recreating the conditions for supply chain problems. I think the inflation risk is clear and present danger. I think doing fiscal expansion alongside a supply-constrained economy, we just saw what that looks like 3 or 4 years ago. So I think the inflation risk is much, much higher this time.
Are you surprised, though, that there wasn't a bigger pushback from some of those hardline Republicans after that Moody's report came out? Because you had at least 4 Republicans on the House who made it clear on the House Budget Committee, that they wanted to see a little bit more tightening. Now, they wanted to cut from social services rather than from the tax cuts, but that argument was there. Why didn't they follow through?
Well, they're just running up against resistance. There are people on all sides of this. So there are some Republicans, as you well know, who are saying, okay, in light of what Moody's has just done, let's get some more revenue. Let's return to the conversation we were having about raising taxes on people making $2.5 million a year. There's not a whole lot of appetite for that. There's just not a lot of appetite for deep, deep cuts or for tax increases at the top.
Stephanie, really appreciate it. Thank you for coming in and spending so much time with us. Stephanie Kelton, a professor of public policy and economics at Stony Brook University. Appreciate your time. All right, coming up, a conversation with Didi Caldwell, the president and CEO of Global Location Strategies, about Trump's administration's effort to reshore businesses, how her firm helps facilitate that effort. This is The Close on Bloomberg.
.30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Alex Steele. If you were expecting price action that is the same as when you had the downgrade in 2011, you are sorely disappointed in the equity and the bond market.
Yeah, I mean, it's kind of basically a nothing burger at this point here. I mean, you did get a little bit of activity, of course, overnight, Sunday into Monday, but as you, or you might see when the numbers pop up on the screen there, basically unchanged more or less around the horn, not just in equities, but even, of course, in the Treasury market.
Absorbing that bad news in a relatively calm way. One stock that's interesting to watch is U.S. Steel. That stock is up over 2%. Nippon Steel apparently has strengthened its commitment to invest in U.S. Steel if President Donald Trump approves the takeover for about $14 billion. And part of that is actually promising to build a new steel mill.
In the United States?
In the United States. Something I don't think I would have ever thought would happen.
I can't remember the last time that's happened.
I'm sure it happened at some point, but I don't know if we were alive.
I don't think so either. But it gets to this idea, too, about when we talk about this idea of reshoring and bringing stuff back here, which areas of it are realistic, right? And when I hear a steel mill being restarted here, I think, okay, is that really going to happen? The cost, the expertise,
workers,
not to mention just how much it costs to actually run those things on a day-to-day basis. How competitive can it be? But there are other parts of our economy that maybe there is an argument to me, a financial argument to be made to do that.
Nonetheless, companies are talking about it. So this chart that we have here shows just how many times companies in the S&P and the Russell 3000 are talking about onshoring, and look at how much that has jumped in just the last few weeks alone. Our next guest spent the first half of her career moving companies out of the U.S. and is now spending the second half moving them back in. Joining us now to discuss is Didi Caldwell, president and CEO of Global Location Strategies. Her firm has guided at least $44 billion in investments for projects that include facilities for auto manufacturing, data centers, and others. Didi, thank you for joining us. So did you expect to have this kind of career right now? Like, what do you do now day to day?
Well, day to day, what I'm doing is trying to help companies match with communities for long-term mutual prosperity. And like you said, for the first half of my career, a lot of the work that I did was moving U.S. manufacturing operations into other countries. And given the change in energy and workforce and the economy, the last half of my career has really been spent on moving them back in. So I think it's really interesting what you're talking about with primary metals and how the United States has all of a sudden become a prime location for primary metals.
Didi, what sectors, speaking of, are you noticing, what clients of each sector are you noticing calling you the most?
Well, I would say that really coming out of the pandemic, we saw a lot of activity in things like batteries and electric vehicles, clean tech. A lot of this was driven by the Inflation Reduction Act. And then obviously you had the CHIPS Act, which caused a lot of activity on semiconductors and the supply chains around that. But I would say that there's, generally speaking, capital-intensive, resource-intensive projects have been increasingly looking at the United States. And I would say that really started with the shale revolution when our energy prices started to become much more competitive relative to the rest of the world.
It's interesting you point that out, Didi, because we were talking before you, of course, about U.S. Steel and Nippon maybe making an overture to actually build a new steel plant. There have been actually some deals in the works with regards to some other metals. That includes aluminum, a very energy-intensive industry. And I'm curious as to why you think that deal got done when it did, and what's the progress so far?
Are you speaking about the EGA announcement?
Yes.
That deal? Yes. Well, I think it's been in the works for a while. I mean, the fundamentals for this project have been analyzed over many years, and it really just made sense at this time. I mean, aluminum is one of those things where the producer does not control the price of their product. And so they try to control their operating costs as much as they can. So it just made sense now in the U.S. with energy prices where they are and also with the growing demand. And we only source about 15% of the domestic demand for aluminum in the U.S. currently. So this will add about 600,000 tons to domestic manufacturing, which would almost double what we have right now. So everything came together at the right time.
That plant in Oklahoma, Didi, I am curious, when you go through that search process, when you were working on this here, how did you end up in Oklahoma rather than the other, 49 states?
Yes, well, it was a very comprehensive process. We really didn't want to leave any stone unturned. And so we basically looked at every state which had the right combination of electricity availability and the logistics infrastructure to be able to make this project a reality. So when you think about logistics, they're going to be importing alumina, and that is most efficiently done in marine vessels, either deep water or barge operations. So that automatically eliminated a lot of places. And then we needed a place where we could have low cost, reliable electricity. So that also narrows the field. So when you get down to that, then you're looking at a select number of states, and then there's only a certain number of those states which are going to have investment-ready sites that can accommodate a project like this. One of the things that we've seen over the last 5 years or so is this explosion in mega projects, which are projects that are over $1 billion in investment and over 1,000 jobs, as well as hyperscale data centers. And that has meant that our inventory of investment-ready industrial sites has been depleted. So when you start to put all of those three things together, it narrows the universe really quickly.
Didi, what onshoring type of facility or industry can't happen?
Wow. Well, you got to think that there's a lot of sunk cost in all of the facilities. I think China has something like $73 trillion worth of industrial investment. So when you make that kind of investment, you're going to run that until you can't get any more return out of it. That doesn't mean, so what we're mainly seeing is onshoring versus reshoring. So it's more about where am I going to put my next dollar as opposed to am I going to close a facility in one location and open it in another.
Are you seeing companies also move, or when they build their next plant, choosing the U.S. versus Mexico or Canada? What's the opportunity set there?
So specifically with Mexico, I think that I tend to divide projects into capital intensive versus labor intensive. And the line that I typically draw there is $1 million invested per job created is the threshold between labor intensive and capital intensive. So a project like this is investing $4 billion in creating 1,000 jobs. That is very capital intensive. And the United States is set up really, really well for that because our labor costs are more expensive than Mexico, but our energy costs are much lower. And we also have better reliability. Our regulations are much more straightforward. Logistics, if you're going to be close to your customer, then your costs are reduced there. But if it's labor intensive, so let's say it's $100 million in creating 400 jobs, then Mexico is going to be much more advantageous for these operations. And typically, we're always looking for a good quality workforce, and logistics can have more or less of an impact, but more often than not, the labor intensive is going to go to Mexico, capital intensive to the US. And then in Canada, a lot of it has to do with the energy supplies there. They have an abundant supply of hydropower, so green energy. So it really just depends on what the criteria of the project are.
Didi, this is really fascinating. We have to talk a little bit more about this when we have more time. Have to leave it there. Didi Caldwell, President and CEO of Global Location Strategies. All right, some breaking news. This involving the Swiss banking giant UBS. We're now learning that company's fight to ward off a bill working its way through the Swiss parliament that would effectively raise its capital costs by as much as $25 billion. They have lost the first round of that. There is a proposed bill that would effectively mean that UBS would have to cover by 100% the capital in its foreign subsidiaries. Based on Bloomberg estimates, that could be as much as $25 billion. Now, this is a rather long process. Our Bloomberg reporter, speaking to people familiar with the situation, says that the bill will be published on June 6th and that it could take at least until 2029 to find a resolution. You're looking at, I believe, the U.S. shares of UBS. They did dip just a little bit there, but now are rebounding and up about 2% on the day. We'll be back in a moment. This is Bloomberg. All right, time now for our stock of the hour. JPMorgan shares down about 1% on the day. Goldman, Morgan Stanley also moving lower. This in the wake of comments that by CEO Jamie Dimon that he's still wary about a number of financial and political risk at the company's Investors Day. We should point out that the bank's presentation also included an estimate that investment banking fees for the current quarter will be down because of the volatility from tariffs. Sridhar Natarajan joining us right now, our chief Wall Street correspondent here at Bloomberg News. Let's start with that second point, because that seemed to be what really moved the market here. I guess I'm not surprised by that, but I am also a little surprised because we came into this year and this was kind of supposed to be the rebound of deal-making activity. What's going on?
This is supposed to be the rebound of deal-making activity. If you do look at the numbers, M&A activity for the year is up 14% over last year.
Okay.
But the problem is 22, 23, 24 were nowhere near the levels of 2021. And bankers have gotten a taste of that, and they want to get back to that level. And to be fair, it's still below the last 10-year averages, because even heading into 2021, you had some really strong years. So bankers want to get back to that level. You are seeing a bit of a rebound. And with Trump's re-election and return to the White House, the expectation was, craziness aside, if craziness was kept at bay, there will be a floodgate opening event and deals would come bounding back. That has not happened, and that's what they want to change.
So what's going on with fees then?
Also, it'll be down. And JPMorgan already has said that in the second quarter.
Down by how much?
In the second quarter, they expect investment banking fees to be down by mid-teens. And remember, some of this is realized fees. When you talk about deal making, that's not even conversations you're having in the second quarter. These are conversations you've had earlier. And in the second quarter, if you go back to April 2, Liberation Day, which was squarely in the second quarter, that forced a lot of change at the corporate level. At least for a lot of April, deal-making conversations were never going to be easy because you have no idea what's going to happen to your business. Capital markets activity was perhaps chill, and also listing activity was chilled. Now you're seeing some of that come back as markets start to normalize. So in Q3 and Q4, some of that effect will play through because, again, all the conversation happening now will perhaps result in some realized fees in the next few months. So that impact and that effect will be felt through the rest of the year.
Talk a little bit more about some of the comments that we got out of Dimon. It seemed like, he was kind of singing from the same hymn book he's been at for a while, but he was very pointed here about some of the risk out there, particularly in certain pockets of the market.
You're right about the hymn book because he's gotten very good at it. And to be fair, he's constantly pointed out that while his business is doing well and they have done a good job of guarding their bank, it is a strong citadel. The problem is there are a lot of things in the world that if they go wrong, could have a big impact on the global economy, and banks are at the forefront of benefiting from global growth. And if that were to take a hit, a bank like JPMorgan would be affected. Having said that, he's been talking about this and various risks for the last few years. They haven't panned out quite yet, but that doesn't mean delayed is denied.
Exactly. All right, Sri, thanks a lot. Really great stuff. Super appreciate it. Sridhar Natarajan, a chief Wall Street correspondent for Bloomberg News. All right, we're 15 minutes away from the closing bell on this Monday. We're going to take you to the bell with Tony DeSpirito, Global Chief Investment Officer of Fundamental Equities and lead portfolio manager of the BlackRock Large Cap Value Active ETF and Value Portfolios. Woo! This is Bloomberg.
Clearly a degree of uncertainty in markets, and this does not help. You have obviously the uncertainty around policy. Now you have the uncertainty around the creditworthiness of the United States. I think that's sort of as I look out over the next 6 to 12 months, that's going to be the big theme amongst markets is where can I get certainty?
Mike Contopoulos over at Richard Bernstein Advisors kicked us off to the close just about 50 minutes ago on this scintillating day in financial markets. And that's sarcasm.
Yeah, you look at that volume.
Yeah.
Maybe we see some volume within tech, because at one point it was down 0.5%. But energy getting hurt a little bit there within the S&P. It's the worst performing sector, which is so odd because oil prices really aren't moving that much today.
Well, I thought that was interesting, too. I didn't know what was exactly driving that. And you also saw a lot of activity in some of the industrial metals today as well. And it gets to this idea, I mean, we kind of came out of Friday's show with that Moody's downgrade, and everyone thought that was going to be the big driver of market action today. It really wasn't. I mean, you saw a little bit of volatility in the overnight hours and maybe right out of the gate at 9:30 a.m., but that's really sort of dissipated. This isn't really what the market's focused on right now.
And what do we make of that? Like, is that good news because the S&P absorbed bad news and in a relatively okay way, or are we going to be due for something if you have the 30-year yield right around 5%?
Yeah.
At some point, does that trickle through the equity market?
Well, definitely those correlations are important. I mean, and we talked about this idea that one of the reasons why you saw that big drop at the open was because you had seen that spike in yields, but as soon as those yields started to tamp down a little bit, then everybody was kind of back into the pool. So I guess borrowing costs could drive the narrative, but until we get there.
But it's not like we're dropping to 3% in the 30 years, so,
No? All right. Well, there you have it. Alex, you're bullish.
I guess I am a little bit, am I? Okay, which is very strange. I'm definitely glass half empty.
All right. Well, it's neither really a bullish or bearish today, kind of a just status quo, if you will. But of course, there are still a lot of longer term issues that the market is trying to parse, from everything going on in Washington and everything in between. Tony DeSpirito joins us right now, the global CIO of Fundamental Equities and the lead portfolio manager of the BlackRock Large Cap Value Active ETF and Value Portfolio. It's great to see you here, Tony.
Good to be here.
We talk about a market that I think has sort of tried to refine its footing coming out of the big ructions that we had in March and in early April. And we've kind of round trip back to at least where we were pre-Liberation Day. And I guess the big question right now is sort of what gives us that next leg of this rally? Is there something there? Is there something the market's looking for?
Yeah, so I think, obviously during that downdraft, the market was just incredibly focused on trade and trade policy. But there's some good things to come now, right? As we get beyond that and we start to see that the worst case scenarios off the table. We're looking forward to more favorable tax policy, deregulation of the banking sector. I think all those are real positives. The earnings season was pretty good. So those are some of the positives out there. So I think there's some good stuff to look forward to.
But what is sentiment like, though, as well? Because when we talk a lot about the rally that we've had over the last few weeks, there's been a lot of talk about the lack of participation. You have a lot of retail in, not necessarily all the institutions back. You still have a ton of cash on the sideline if you go by what's in money markets and short-term treasuries. I mean, when do we get maybe a little bit broader participation?
Yeah, well, retail definitely got it right.
Yeah, they certainly did.
Yeah. So congratulations to retail.
Yeah.
There is a lot of money still on the sideline, so I think that's more good things to come. And then the only hesitancy would be on the valuation side, which is where I think investors should remember the downturn, build resiliency into your portfolio. You can either do that by buying high quality businesses or create a margin of safety through buying value stocks.
What are those right now?
Yeah, so on the margin of safety side, I think the list of high-quality staple-like earners has really narrowed. I mean, you see consumer staples kind of under attack, both because they've overpriced their product and GLP-1s, and so maybe they aren't as stable as they were historically. And then on the healthcare side, pharmaceuticals are kind of under attack in terms of both the patent expirations as well as some of the policy around pricing. And so it really narrows the number of companies. I think a company like Microsoft is pretty interesting in that it has kind of become the new tech staple, I'll call it. And you have to pay up a little bit for it versus one of the large, traditional consumer staples companies, but not that much, given that you get a lot better earnings growth at a lot better quality, both in terms of the business and the balance sheet, right? This is a company without any debt, as opposed to many consumer staples, which are levered.
So flip it. What would you avoid then in this kind of environment?
Yeah, so I think on the more cyclical side, industrials, I think industrials are kind of highly priced and there aren't really any positive catalysts. Whereas the flip side, on the cyclical side, I see banks, particularly money center banks, as attractive because of that deregulatory impulse, right? I think that means lower capital requirements. That means they can return more capital to shareholders in the form of buybacks and dividends. It also means they can lend more money, right? And that's good for their growth.
Are you seeing, though, an actual embrace of, I guess, those kind of value plays, if you will? Because it seems like every time we have these ructions and people come back into the market, they still gravitate to some of those large cap names. And I know you're making the case that maybe Microsoft might actually be more of a value play than just necessarily growth. But I do wonder if the mentality is that there is something out there other than just those large cap, big cash generator names?
Well, I do think the market is poised to broaden. I mean, when I look overall at the Mag 7, the gap in growth rate between the Mag 7 and the rest of the market is narrowing. So like, if you look at estimates for this year, it's supposed to be about 10% or maybe a little less, high single digits. That peaked out in 2023 at like a 30% gap. So that gap is narrowing, and yet the valuation gap hasn't. I see that as the opportunity.
For folks who are looking for investment opportunities that aren't necessarily, okay, let me try to find and pick the winners and the losers in terms of stocks, what are the structural themes that you're seeing people go after? I know we've talked a lot on this show, obviously, over the last 2.5 years about AI and some of the other, the ecosystem that feeds into that. Is that still in high demand?
Yeah, AI is still very much a real theme, but I don't think it's a set it and forget it theme. I do think it's a theme that you got to play in an active way. I mean, the beginning was all about the hardware layer, the semiconductors, the chips, et cetera. I think increasingly we're going to move to the software layer as we start to see applications, et cetera. So I think you got to change how you play that investment theme.
Do you think that we need less bad news or good news to really find stability in the market?
Yeah, so I think we're now at the point of stability. So as long as we don't have bad news, I think we'll continue to be stable. But to really drive it up, that would require good news, which could be earnings, could be tax policy, could be deregulation.
Just real quickly before we let you go, what were your thoughts on the Moody's downgrade on Friday?
Not really news.
Yeah.
I mean, yes, government debt is a problem. We're at about debt to GDP of about 1 times. And that's a magic number because that's where it gets hard to grow your way out of it. So if you look at our deficits, about 6% of GDP.
Yeah.
Nominal GDP is growing just under 5. So the debt to GDP is growing if we don't do anything. That said, this is not new news. And Moody's is the third. It's kind of last in line. S&P downgraded in 2011. Fitch in 2023. So I don't really see it. I see it as a lagging indicator.
All right, Tony, great stuff. Tony DeSpirito, he's the Global Chief Investment Officer of Fundamental Equities and Lead Portfolio Manager at the BlackRock Large Cap Value Active ETF and Value Portfolios, counting us down to the closing bells, which are just about 2 minutes away. Stocks relatively unchanged on the day. They had spent a big portion of the day in the red. The Russell still holding on to most of its losses, though we should point out the S&P, the Dow, and the NASDAQ 100 poking into the green. A full breakdown of all of today's price actions starts right now with our global simulcast.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostic here with Alex Steele, taking you through to that closing bell. It's a global simulcast, and it starts right now. Scarlett Fu in the TV studio, Carol Masser and Tim Stenovic together, believe it or not, in the radio booth. All 5 of us back together here on this Monday afternoon as we welcome our audiences across all of our platforms, including, Carol, our partnership with YouTube.
Yeah, we are across all the platforms. We are everywhere. I kind of find it fascinating that I guess investors are like, yeah, another downgrade. Okay, we kind of maybe thought it was coming, not surprising. And investors, certainly the equity side of things, seem okay with it.
Yeah, I mean, it also seemed to be okay with it on the bond market. You saw some buying on the long end, on the 30-year, when there was concern that, it had gone above 5%. I don't know, maybe everyone's desensitized. I don't know what the answer is.
I think that's a good part of it. I mean, 5.03% on the 30-year earlier today. But you just look at the reactions in the past. In August 2011, when S&P downgraded the U.S., the S&P lost 6.7%.
Right.
In August 2023, the S&P lost 1.4%. And now we're unchanged.
Well, you have to also wonder, too, we did hit that 5% level, right, in the 30-year. So if that's really the top, so then you're going to bring in buyers, and that's going to sort of be a self-correcting mechanism.
Yeah, and it gets to this idea, too. I mean, you point out, sort of the big outsized move that we had back in 2011. I mean, that was a shock, right? I don't think anyone really saw that coming. And as a lot of our guests have said on the program today, it's like, look, S&P already did it. Fitch already did it. Moody's, it was kind of like, what took you so long?
Yeah, exactly.
Yeah.
Meantime, you got Fed officials saying, hey, folks, don't get too excited about rate cuts. Maybe we'll get one this year. We'll see what happens.
All right. Well, the market's definitely taking Friday's news in stride here and maybe focusing a little bit more on the progress on that tax bill and some of the other efforts in Washington here to make things a little bit easier for companies. news. Green across the screen for at least 3 of the major indices here in the U.S. The Dow Jones Industrial Average up by more than 100 points, or 0.3%. The S&P 500 is going to close up by just about 5 points, or about 0.1%. The Nasdaq Composite in the green, but we'll call it unchanged, only up about 4 points on the day. Similar move for the Nasdaq 100. Though in the small and mid-cap space, you still did see significant declines on the day. Dow Transport's down 0.3%, and the Russell 2000 down 0.4%. Carol.
All right, Romain, quick check on the S&P 500, guys. Kind of an even split here when it comes to winners and losers. So you've got, 255 names to the upside gaining ground on this Monday, and Scarlett, 246 to the downside.
All right, let's take a look at the IMAP right now. You've got 7 groups in the green and 4 in the red. Let's start with the gainers here. Healthcare shares up almost 1%. Consumer staples and industrials each gaining about 0.4%. The biggest laggard is energy, losing about 1.5% right now, 1.6%. And in fact, for the year, it is down about 2.2%. We also have some weakness in consumer discretionary and tech as well, but those are more leaning towards unchanged.
All right, guys, so kind of a mixed bag there. Let's get to some of the gainers. There were really some outperformers in the Monday trade. Paramount Group, ticker is PGRE. This one up as much as 20% during the trading session, finishing with a gain of about 13%. It's a REIT. It's a major office landlord. New York City, D.C., also San Francisco, about a $1.1 billion market cap. Surging, as we said, the company's board initiated a review and evaluation of strategic alternatives. Some speculation might that mean an outright sale of the company. And this is all coming after it named a new CFO and treasurer effective immediately. Keep in mind, Wall Street Journal also making some points about this company's had a lot of red flags or that have been out there in the last few months. And so this company, looking kind of to see what's next here in its next chapter. Take-Two Interactive. Outperformer, up about 3.5% in today's session. It was a top gainer in both the S&P and the NASDAQ 100. Did report earnings last week, and we are seeing the analyst community come in and weigh in on those earnings. So analysts raising price targets for the company since it reported earnings. 16 changing price targets. The average change was up 11%. 15 analysts raised price targets by an average of 12%. So some optimism on the street. And Novavax, talk about optimism. Up as much as 30% during the session, finishing with a gain of about 15%. U.S. regulators fully approved the company's COVID vaccine, so easing some investors' concerns after the clearance was delayed.
Just in time.
Yeah, exactly. Exactly. Good stuff. So anyway, some
Well, it's not mRNA, so I think that if you needed different sourcing, that would be something for you.
Yeah. I will say Moderna also an outperformer because maybe there's some, different thinking. I think everybody thought the government was going to be so anti-vaccines, and yet this happens for Novavax, and so investors also plowing into Moderna up about 6% today.
Okay, you got the gainers, Carol. I got the decliners. I do want to just take a look.
You had some trouble here.
Oh, yeah. I just had to do a last-minute switch. But you know what? The team was great. They were able to switch it out for me, so I appreciate that. I want to start with shares at JPMorgan.
Just imagine, no one would ever have known if Carol had.
I know.
I know.
Yeah. Isn't, with friends like Carol?
Do I come across like a little sister? I should.
Killing me. You're killing me. 1% to the downside for JPMorgan. The company did reaffirm its net interest income forecast for the full year. They said an investor day earlier today. Shares fell earlier in the session, though. They hit a session low after an executive at the company said investment banking fees will fall. We also saw peer organizations fall as well. The company's CEO, Jamie Dimon, in a speech did warn against complacency in the face of a slew of risks. He cited everything from inflation and credit spreads to geopolitics. Ultimately, shares fell 1% today. I want to talk about solar stocks, in particular Sunrun, ticker RUN, down 7.8%. Shares of solar companies slumped. This after Republican lawmakers said that they had secured a commitment from leadership to end key clean energy tax credits earlier than planned. It's part of a sweeping deal aimed at allowing President Trump's giant tax and spending package to advance. Sunrun fell by about 7.8%. And finally, shares of Shake Shack, 1.6% to the downside. They fell after TD Cowen cut the recommendation on the company to hold from buy. They cited an already high valuation amid a challenging consumer spending backdrop.
Well, here's the interesting part when it comes to the bond market, guys. I mean, coming into the session, it looked like we were going to see some pretty intense action. The long end was selling off by 6 basis points already. Then we reversed course, and we actually ended with the whole curve lower by about 2 to 3 basis points. I do want to point out, though, that the 30-year yield still hit that 5% level. We hadn't seen that since 2023. And you look at a technical basis, and we're looking at a golden cross, guys. Woohoo! Okay, so the short-term moving average looks to break above the medium-term moving average. So 50-day crosses above the 100-day. That's a golden cross. That tends to be a bullish signal, which means higher yields. And you wonder at some point, are we at that tipping point where yields wind up directly hurting stocks?
Yeah, it's a really good point, right? You kind of wonder where it all goes next. I have no good segue except what?
There's no segue. Just take it because it's awesome.
All right, let's talk about the maker of Dum Dums and
Who? What? What did you call me?
That's what I was,
don't take it.
That's what she calls you when you make a mistake.
Dum Dums. Lollipops.
Oh.
And then you also have, sweethearts?
From our
You know,
youth.
those cute little candies.
Yeah.
You know what they are. Well, apparently the maker, the CEO of the company, Spangler Candy Company, makes all this good stuff. Apparently kind of pushing back on this idea of switching from synthetic dyes to natural colors. He's worried about the taste and maybe whether consumers will like it as much.
Yeah, take beet juice, for example. It turns out beet juice, it might be a nice red, but guess what? He says it tastes like beets.
Yes.
And that's an issue.
Let me tell you,
lollipop.
this guy is
That's
a
an
national
issue when
hero.
it comes
He
to
should be in
candy.
charge of HHS. I totally agree with him. Look, if you're going to eat candy, I mean, what it's like when they have, like, upstairs, they have these healthy gummy bears, right? But, like,
Oh,
like
this
I
is
don't.
personal, guys.
I mean, it is personal. Like, I mean, I don't eat candy because I'm trying to be healthy.
It's called candy, not vegetables, right?
Yeah, thank you. So,
Yeah.
you know, let me get my chemicals.
Also, and didn't they also say, like, it could be dangerous for allergies, too? Like, that was
Yes.
funny. Like, here's the made-up stuff. That's fine. But if we give you real things, your allergies could kick in.
Well, so what you're saying is a candy just needs like a warning label. And then everyone's all good with everything, right?
Doesn't it bother you guys that this red dye number 3, which has been linked to cancer, and now they're only going to start phasing it out, I guess, in early 2027 will be banned? Isn't this the stuff that was already banned in makeup? Like, why is it even still there?
But I don't know why. I don't know why you
does it
even
need
need
2
it.
years to
I don't know why you need it.
Exactly.
Carol
Just-
Nasser.
But
just
to Carol's point, I don't know why you need the dye. I mean, if you're eating something that tastes like it's not the flavor that the concern is. That's the concern if they use
Bring
the dye.
on the
But
beet juice.
If it's clear, Crystal Pepsi. Remember Crystal Pepsi? It was so successful.
What?
No, it wasn't.
No, I don't remember
being
this
totally
at all.
facetious.
No,
Yeah.
I know, but I don't remember that at all.
It was
All
for a
right.
hot second in one
I
commercial.
wonder what Oscar the Grump or Grunch.
Or Grouch. Oscar the
gosh.
Grouch.
Nice
Oh
segue,
my
Carol,
goodness.
because
Oh my gosh.
it looks like Netflix is making a
You're so
play
in the zeitgeist,
for
Carol.
Disney for that children's audience. Did you guys read the story that Netflix will be airing new episodes and old seasons of Sesame Street?
I love this so very much.
For people who've cut the cord completely and don't have PBS anymore, then you can get it now
But
on
you used to have
Netflix.
HBO. It used to be on HBO. You get all the reruns and the new ones. It was fantastic. That partnership was broken down, so it's so great that you now have a way to get it.
Yeah.
Huge Sesame
Well, and a
Street
way to
fan.
get it. And what I really love about this, too, is that you have a way to get it without paying because they are partnering with PBS on this. So they're actually going to, unlike HBO, which took it off PBS.
I know.
And you had to wait, several months to see a new episode. Netflix isn't doing that.
No.
Yeah, they're going to air, when it airs on Netflix, it'll be airing on PBS.
Letter of the
So
day's
if you
end.
can't afford the, however much it
And
costs
for
for
what?
Netflix subscriptions, you can just
For
watch it there.
Netflix?
And you can sit there with your Dum Dum lollipop, pineapple to be sure.
Oh, gnarly. You don't like pineapple.
Did you say gnarly?
I did say gnarly. Because pineapple
Yeah.
lollipop, what's the point? Just don't even eat it.
Alex, are you
Sounds
into
great.
beet juice? Would you like the beet
She
juice?
would like
No, I would totally
beet
like
juice
the beet
lollipop.
juice.
I
Yeah,
could see it.
might.
I like a beet juice, but not with my Dum Dum lollipop. The two
right.
should be separate.
I'll do it with you, Carol. It's cool.
All right.
Tim, when's the last time you even had a lollipop?
Bye-bye, Dum Dum Remain. No, I'm just kidding. Just kidding.
Wow.
Aw.
You said it before.
Wow. Okay.
I guess it's better when we're just
You're not that far away from me,
Hey, I'm protected in this
Okay.
glass shield.
I
I'm
know.
just telling you. All right, guys, that's a wrap. Good to be back together. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We do love each other. I swear. We will see you. I know Alex is heading out. Scarlett's going to stick around with
She's
Romaine.
already walking away.
All right, we will see you again. Same time, same place tomorrow.
And our coverage does continue here on Bloomberg Television. A discussion on the U.S. dollar, a discussion on recession risk, and how to diversify in the current climate. We got a great conversation coming up with Grace Peters and Stephen Parker, the co-heads of global investment strategy at JPMorgan Private Bank. They got a new note out on their outlook for the future, and well, you don't want to miss it. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. An interesting day on Wall Street.
It started off that way.
Yeah, well, I don't know. It was a little boring, Scarlett. We came into today, as Scarlett just alluded to, kind of expecting a bit of fireworks. We had that downgrade of the U.S. credit rating on Friday, and you actually did see some pretty significant price action in the overnight hours in the Treasury market on Sunday, and of course right around the open here on Monday. But that abated pretty quickly here, and partly was the big reason was the second line of your screen. You did have yields on the long end of the curve break above that 5% level, but they dropped back down pretty quickly. And as those yields drifted back down into the pocket, you started to see equities start to rise. They were down about 1% here on the day, closing out the day relatively unchanged. A little bit of stronger activity when you get to certain pockets of the market, and maybe that gives a sense, Scarlett, here that maybe people aren't too worried about what's going on right now with the fiscal deficit and the budget, and they're maybe content with the status quo.
Well, these are very long-term structural issues that we've been pricing in for a while now. Let's take a look at some individual movers, and we're going to start with First Solar. And in fact, this is, the case for most of the solar companies. Down after a conservative Republican lawmaker said that conference leadership agreed to end clean energy tax credits earlier than planned as part of the compromise to move the tax bill, the big, beautiful tax bill along. So we've seen solar power companies decline today as a result. United Healthcare up 8%, adding to Friday's 6% rally, and that's following an 8-day stretch in which the stock lost about a third of its market value. The returning CEO and the CFO both buying shares, a signal that they want to signal their confidence in the beaten down company on concerns over this investigation over Medicare fraud, or according to the Wall Street Journal. But our top story this hour is something that Romaine alluded to earlier, which is Moody's. Moody's is sizing up U.S. borrowers and downgrading its view as a result. And this applies to both the government and the nation's biggest banks. On Friday, Moody's downgraded the U.S. government's credit score to AA1 from AAA, joining Fitch and S&P in stripping Uncle Sam of its top rating. At blame successive presidential administrations and Congress for swelling the budget deficit and debt burden. This afternoon, we saw Moody's cut long-term deposit and counterparty risk ratings for banks, including B of A and JPMorgan Chase, saying that the federal government now has less ability to support these firms. Romaine?
And it's kind of interesting, too, to see the reaction in the FX market. The dollar sliding after that downgrade. JPMorgan Private Bank, though, they're weighing in on the currency's outlook in a newly released mid-year report that, of course, was written before this downgrade, saying that, quote, the U.S. dollar's status as the world's reserve currency won't suddenly vanish, but there is elevated risk of an era of dollar decline. Pleased to say that the authors of that report join us right now. Grace Peters and Stephen Parker are co-heads of global investment strategy at JPMorgan Private Bank, and they join us here in Studio 2. Great to see both of you.
So lovely. Good to be here.
Absolutely. I'm sorry I didn't wear my bow tie today. Thanks. Tom Keene would be proud of you for doing that.
Appreciate it.
And I do want to start off with your call on the dollar, because I think we've seen the dollar weakness over the last few months here, and everyone's been talking about this idea. Is this sort of the end of, king dollar? Is this the end of American exceptionalism? You're making the case here that, we might see a little bit of a ratcheting down in the dollar's strength, but by no means is its dominance going away.
Yeah, that's correct. I think the dollar story has been, the headline along with tariffs this year. And I think most investors acknowledge the fact that the dollar may have been a little bit overvalued, but, the premium growth that you were getting in the U.S., the policy certainty that you were getting in the U.S., kept foreign investors coming to get more dollars. Mm-hmm. I think that question now is, and what we're seeing from a policy and a growth perspective, is a narrowing of that premium, not the end of U.S. exceptionalism, but causing investors globally to reassess and question the fact of whether they should be reallocating to non-dollar assets.
Well, I pose this question to you, Grace, because, of course, a big part of this story has been this reallocation, or at least a consideration of reallocation geographically. The idea that on a relative basis, maybe Europe offers better potential returns across a variety of asset classes. When you started to see some of those flows of money into those asset classes, was that a signal that maybe people were abandoning the U.S., or was this just simply some sort of natural cycle and we were making too much of it?
I think it's a signal, but not so much that we're abandoning the US. As Steve mentioned, the dollar's been overvalued for a while. Plus, we know that concentration risks in the US market have been growing for a while. But we haven't really had a catalyst to unlock, sort of some of that value. And I think, to me, that the flip-flopping that we've seen of US policy so far this year, plus actually the response we've seen in Europe with a tremendous amount of spending announced by the German government. 12% of GDP is a huge number, and that is enough to move the needle on European growth and European earnings. So the confluence of those factors at a time when valuations in Europe are cheap, and as you say, there's a degree of flows looking to be repatriated. Together, I think, paints a compelling picture. And for our clients sort of saying, look, actually, I am very overweight the dollars. What can I do? The two obvious things are, number one, buy European equities, and number two, buy gold. And so I think that's where you've seen some of these flows going, and I don't think that story is over yet.
Germany spending more is a direct result of the changing geopolitical conditions. How reliable is any move that any government makes right now? Because all of it is in response, almost, I don't want to say knee-jerk reaction, but it's very much dependent on someone else making the first move.
No, I think this is a more enduring shift taking place in Europe. I mean, I think there's been a real realization from European policymakers that for too long now they have over-regulated their own companies and under-regulated national security risks. And so I think this is the start of many measures. We've mentioned the German fiscal spend, most of which is going towards infrastructure. Defence is another huge area, and we've got the NATO summit coming up at the end of June. I think you're going to see more announcements, as you did already last week, more spending on defence. So I do think that this is a durable shift. It probably adds 50 basis points to maybe 1% to growth to the Eurozone when we look out next year. It's obviously going to take a while to drip feed in, and we think when it comes to earnings, this will mean mid-single-digit earnings growth for European companies, but more for key sectors like industrials and for financials.
Yeah, 50 basis points to 1 percentage point is pretty significant for a region like Europe. So let me come back to you and ask you a little bit about the currency situation, because you talk about currency diversification with this dollar weakness. When would we know at what point we are actually seeing the U.S. dollar being replaced as the reserve currency of the world? Is it going to be something gradual and then something suddenly will show up?
Well, I just don't think that today, when you look at the other options around the world, that there is a single option that could replace the dollar. The dollar is still involved in 90% of FX transactions around the world, and that's not going to change anytime soon. I think what we're going to see is something that central banks have already been doing, which is gradual diversification to other key currencies around the world, be that the euro, be that the yen. And then, as Grace said, investors are also looking to sources like gold to add that diversification.
It's kind of interesting, too. I mean, we have right now here in the United States some efforts to try to address economic conditions. You have a tax bill moving through Congress that ostensibly is supposed to be about fiscal stimulus. Of course, that tax bill, part of the reason why Moody's made the decision over the weekend to downgrade the U.S. credit rating. I am curious as to how these fiscal measures, or lack thereof, factor into investment allocations. I know these are such long-term structural things, and we've been talking about our deficit here in the U.S. for as long as I've been alive. So when does it become an investable event or a reallocation event that you have to consider?
I think that's now. I mean, our main theme for 2025 has been strengthening portfolio resilience, which is intended to, really make actionable investment recommendations around the fact that the tail risks are large. And these are known unknowns, as you say, sort of the deficit, the potential for further steepening of the curve. There are things that investors can do to intentionally diversify to protect the portfolio against these risks. Infrastructure, we think, is a great investment when you're thinking about potentially a higher inflation world, which could come from deficit concerns, but also from other issues, the reorientation of supply chains and the aging demographic and immigration changes as well. Gold, we've mentioned. Assets that specifically monetize volatility is another one. We think markets are going to make new highs over the next 12 months, but with a fair amount of volatility. So that would be equity-linked structured notes, and it would also be hedge funds, particularly macro and relative value. So when you start putting these pieces together to complement, say, a classic stock bond portfolio, we think that the time is now to start thinking about these longer-term risks and taking action.
Stephen, when you look at a sector like tech, which is so massive, specifically when it comes to AI, should you be looking at that as U.S. companies or as its own asset class in a way?
The interesting thing is, coming into this year, one of the reasons why the U.S. had outperformed so long is because of this concentration in the tech sector, with AI being the most recent driver. I think the DeepSeek news, which, if you remember, was actually the first thing that shocked markets earlier in the year before tariffs, caused investors to question whether this was just solely a U.S. story. I think the trend that we're seeing, which is cheaper and faster to market AI, which is what DeepSeek brought us, is a shift in terms of the ultimate beneficiaries of AI. what was once a really concentrated story around the hyperscalers, the hardware names. We think the next regime is going to be about that story broadening out and the benefits of AI accruing to a much wider audience, which is why we really like software specifically, because as you transition from the hardware build out to the applications that AI will actually enable, software both in the public and private spaces where we're
Just real quickly, we only have about a minute left, but I'm curious on the AI investment. There's been a lot of talk about trying to find AI investments that aren't necessarily directly tech. The idea that the users of AI and whatever sort of benefits it has to their bottom line and their productivity. Do you see opportunities there?
Well, I think AI is going to ultimately impact every sector of the economy and therefore every sector of market, every geography as well. And so China AI would be another story that we'd tap into as part of that global diversification piece. But this is why I think the environment is strong for alpha, because as these winners and losers comes through, that should benefit.
Grace Peters and Stephen Parker at JPMorgan Private Bank, thank you both so much for coming in.
Thank you.
Coming up, we've got the top three, where we focus in on the top three movers and shakers at the center of the day's biggest stories, and we feature two Trump administration officials. That's next. This is The Close on Bloomberg. It's time now for the top three, where we name drop the people driving some of the day's most talked about stories. And first up is Howard Lutnick, the U.S. Commerce Secretary, divesting his ownership of his Wall Street businesses, including Cantor Fitzgerald, to his children and investors led by 26 North, and in the process remain cashing out and gaining hundreds of millions of dollars.
Yeah, I mean, this was kind of long expected after he had agreed to take the White House job. There was a lot of speculation that this was actually in the works. The greatest thing about this story isn't really the details, it's really the photos of his children and the lives that they've been living. So obviously two very young guys who now, I guess to a certain extent, they're not really responsible for anything, but maybe they become
increasingly
responsible for
they are.
it. Yeah,
right?
So, maybe this is now potentially the future of this firm. And,
absolutely.
It'll be interesting to see
New
how that all
generation of
plays
leadership.
out.
And let's not forget the details do include not having to pay capital gains taxes because he is serving the public. And he just has to put his proceeds in treasuries or like broad mutual funds.
Yeah, kind of interesting, too, to see 26 North a part of this. Of course, the firm founded by Josh Harris. So now, what's it, the Commanders, right? Mm-hmm. You're a football person, aren't you?
I am.
Paul Atkins, you heard of him? He's the SEC chair. And now he's asking staff to consider revising 23-year-old rules for private funds. Now, this is a big deal. Basically, if you want to get into a closed-end private capital fund, you need a $25,000 minimum investment. He basically wants to lower that. It sounds like almost to next to nothing here. This has been, of course, also something that's been talked about a lot. And we know that a lot of these private capital firms have found other avenues to find slightly less wealthy investors and get them in the door. But for closed-end funds, they did not have that option. This appears to be an option put on the table.
This is all about the democratization of the private asset industry, right? Making it more accessible to everyone. And of course, in March, Apollo and State Street teamed up to launch this private credit ETF, which, launched a great fanfare, but hasn't necessarily done a whole lot.
Yeah.
All right, as for number three on the docket, Wendy McMahon. Bloomberg learned that the CEO of CBS News resigning under pressure after Paramount, the parent company, raised concerns about the fairness of its reporting. And this came after Paramount's board met Sunday over issues regarding her leadership. And of course, Paramount is trying to complete its merger with Skydance. It needs a certain regulator sign-off.
Interesting to see her being, some reports have said that basically forced out because she didn't want to go along with this. And I guess they'll find someone to put in there who will. When we come back, we're going to go back to the markets here and take a look at this day in history. A day when Michael Burry began to build his big short. That's coming up after the break, right here on Bloomberg. All right, let's take a look back at this day in history and one of the greatest trades ever made, which began to unfold on this day, May 19th, 2005, when a one-eyed 33-year-old fund manager named Michael Burry closed on a deal for the first ever credit default swaps against subprime mortgage bonds. It was an improbable deal valued at $60 million. Now, that's a paltry amount for any Wall Street titan, but a fortune for an improbable speculator working from a home office 3,000 miles away in California. Now, his story is legend that doesn't necessarily need to be completely retold here. A medical resident who in his spare time delved into financial market research and parlayed his knack for fundamental analysis into fundraising millions of dollars to invest in something that had never been invested in before. He bought CDS contracts on $10 million each on 6 different reference securities of subprime mortgage debt. The contracts, when held to maturity, effectively act as an insurance policy. The debt holder pays a premium to the bank in exchange for a contract that compensates if the value of the underlying securities falls below a certain threshold. Burry, though, took it a step further, realizing you didn't have to actually own any of the underlying mortgages and you could take out a CDS contract anyway, a contract that would increase periodically in value as the price of that underlying asset fell. Now, these arrangements weren't new. Remember, Blythe Masters at JPMorgan pioneered the vehicles a decade earlier, but no one had ever actually used them to speculate on individual subprime mortgage debt. Even the Wall Street banks thought what Burry was doing was outlandish. What they didn't realize was that he had actually sniffed out a major fault line in the mortgage market. By August of 2005, he was sitting on $750 million of swaps. And by December, it really became clear that the banks, they were on the wrong side of that trade as more subprime mortgage delinquencies began to swell. All told, Burry's fund is said to have made around $800 million in profits from that big short. And while no means the greatest trade ever, it was certainly one of the most novel executed at that scale. Scarlett?
Romaine, I kind of forgot what he looked like because whenever I hear his name, I now think of Christian Bale from the movie The Big Short. All right, similarly, let's talk about another company that's also making a big bet on itself. During the HVAC company's investor day today, we're talking about Carrier. It said it's targeting 6 to 8% annual organic sales growth in the medium term. I'm pleased to say joining us now is David Gitlin. He is chairman and CEO of Carrier, which is a world leader in heating, air conditioning, and refrigeration solutions. Great to see you here.
Great to see you, Scarlett. Romaine, thank you for having me.
So talk us through what's new in your investor day this year. You had an investor day in 2022, and it looks like a lot of the goals are similar. What's different this time around in 2025?
Well, what we said is that we did everything we said we were going to do back in 2022. We said we'd grow 50 bips a year of margin expansion. We grew 100. We said we'd grow EPS about 10% a year. We've grown our EPS 15% a year. We did what we said on our effective tax rate. We said what we would do on free cash flow equal to net income. But we did say that we would grow sales 6 to 8% a year. The last few years, we've grown 4%. So the whole investor day we had 4 hours this morning at the NYSE was how do we get consistently 6 to 8% growth? So we introduced a growth algorithm. The market, we said, call it low single digits, be conservative. And then we had a three-pronged strategy to growth. One is outgrow the market through products, so share gains. The second was aftermarket, where we've said aftermarket will grow double digits forever for us. And the third is kind of a new frontier, is systems offerings. That combination gets us to 6 to 8% a year.
So it sounds like there's some tailwinds in your industry. Walk us through which of it is structural, which of it is cyclical.
There's a couple of unique tailwinds, for example, right now around data centers. If you think about a typical commercial office building, it may have 3 chillers. A data center may have 150. So the massive investments we're seeing in data centers plays right to our strengths. And we've just introduced a brand new, very unique offering that we call Quantum Leap, which is a combination of traditional cooling with a chiller and air handlers, but also a new liquid cooling, which is a direct-to-chip cooling. And our combination is very unique because we're the only ones in the industry integrating traditional cooling, liquid cooling, an entire building management system, server management, all into one offering.
What's been the demand for that? Because I know we've talked a lot on this program about the build out of data centers and such, but there's also been a lot of sort of promises to build things, and I know the building hasn't actually started for some of that. So what's been the uptake here, and do you expect it to increase?
We do. Last year, we were about $500 million in sales for data centers. This year will be $1 billion, so 2x. We're now taking orders for 26, 27, even into 28. So the hyperscalers are growing at different paces right now, but very, very strong demand. And what we're seeing is increased demand for colos, the co-locators, especially in Europe and China.
Really? Are you involved at all in some of the administration's push to help build data center projects in the Middle East and elsewhere outside of the U.S.?
100%. Yeah. We're very much working on new wins in the UAE that were announced recently. We have a lot going on in Saudi Arabia, so we see the Middle East as a real good growth vector for us.
You also have a lot going on in the U.S. because over the past 5 years, you've definitely grown and focused on expanding your U.S. workforce by approximately 20%.
Yes.
How much of this was in response to the changing political winds? How much of this was a strategic advantage for you specifically?
A strategic advantage. We like to be where our customers are. About 50% of our sales are in the United States. So, you know, we've grown our workforce, as you said, 20% over 5 years. We're by far the biggest player that's headquartered in the United States in our industry. And what we announced last week was an incremental $1 billion investment in the United States over the next 5 years, which will create 4,000 additional jobs. And these are very technical jobs. It's a combination of R&D. You can think mechanical, traditional software and electrical engineering, technicians that are out in the field. And we also announced that we're going to establish a brand new manufacturing factory in the United States. We're very proudly in North Carolina, we're in Georgia, we're in Tennessee, but we're now going to build a new factory. We're looking at a location like Texas, but we haven't finalized the choice
With
yet.
regards to some of those hires and the technical expertise you need for these jobs, do those people come to the table with that, or do you have to train them?
It's a combination. That's part of the negotiations with the states right now, is we are looking for some support on some of the technical training, but we will train about 100,000 technicians a year. So we know how to train and then integrate them, whether it's technicians or even highly skilled manufacturing labor as well.
So when it comes to what we're seeing in the higher education landscape, this idea that the government is going to reduce funding to universities, how does that impact a company like you who is looking to increase your footprint in the U.S., hire more? Is there a direct cause and effect for a company like Carrier?
You know, we see it as a very competitive labor environment for the kind of skills that we're looking for right now. You know, it's when we look at technicians, we've said that we're going to add 1,000 technicians in the United States over 5 years. We try to partner with technical schools in particular, and that partnership has been very strong. But what we also have to do is establish training universities within our four walls, within Carrier. So we've seen great success, especially recently, over both manufacturing, R&D, and technical labor hiring.
So for those American companies that are struggling to bring back jobs, bring manufacturing jobs back to the U.S., how would you advise them? What would you say to them to kind of rethink what they're able to do?
You know, it is competitive. For example, we have a manufacturing site just outside of Memphis in Tennessee, and we do compete. We'll compete with Amazon. We compete with FedEx for labor. What our goal is to create an environment where people want to come and people want to stay. So people want upward mobility. People want to feel like they have a lot of upside on the compensation side, and they want to be a part of a company that matters. And one of the things that we have is our purpose statement is enhancing the lives we live and the world we share. What we do matters. We contribute. Our industry contributes to climate change, so we can be part of the solution. That matters to people, that we can create a safer planet for generations to come. There's 3.5 billion people in the world that live in the hottest parts in the world. Only 10% of those folks have air conditioning. So we have an ability to impact people's lives all over the world. And people want to come to a company and feel like they're part of something that really matters. So we've invested in our culture, we've invested in our people, we've invested in our workforce, and that's been paying off for us.
Is the growth that you're looking to do right now, is that going to be primarily organic, or are you looking for acquisitions?
It's primarily organic. You know, we're coming off the heels of integrating a $13 billion acquisition with the German acquisition that we did with Viessmann Climate Solutions. That's gone phenomenally well. The last year, the sales were a little bit lower than we anticipated, but it's a truly world-class company that's going to create value for years to come. Right now, our whole theme this morning was on organic growth, that's 6 to 8%, with a very clear strategy to drive it and a lot of confidence in the team to do it, and a very different portfolio than we had just 5 years ago.
All right, Dave, really appreciate you coming here. What's tougher, facing investors for 4 hours or facing Scarlett for the last 10 minutes?
Facing Scarlett, and you are great. Well, thank you for having me.
David Gitlin, the chairman and CEO over at Carrier. Scarlett.
All right, let's take a look at how shares of Carrier closed on the day, up about 0.3%. And if you look at the broader market overall, a mixed day here with the S&P 500. It was negative, now it's positive, but just barely at this point, right? Up 0.1%. You did have the dollar consistently lower throughout the day after Moody's downgraded the U.S.'s credit rating.
And gold's consistently higher as well. And we should also point out in the swaps market, definitely not as sanguine as maybe what you saw in the Treasury and equity space.
Absolutely. And the 30-year yield did poke above 5%, got to 5.03%, but as you can see, closed at about 4.9%. This is The Close on Bloomberg.
so much of our economy is based on faith that we will deliver on the things that we say that we've promised for the future. When you start to see the markets waver a little bit, I think people are asking the question, do we still have that same level of faith? I think the sign that rates have started to come back down and the markets are sort of returning back to a normal stasis suggests that they think there is that likelihood moving forward, and we'll just have to see where it goes.
The president of the Atlanta Federal Reserve sitting down earlier today with Bloomberg's Michael McKee. He asked him point blank here about that Moody's downgrade of the U.S. credit rating on Friday, and you heard his response there. You saw the reaction in the markets today, and we continue that conversation with an analysis about what's next. Sarah Bianchi joins us right now, chief strategist of international political affairs and public policy at Evercore ISI. I want to focus in, Sarah, on one particular word that Atlanta Fed president used, and that was the idea of faith, the idea that so much of our credit worthiness, if you will, is really just based on the general idea that people believe that no matter what, we're going to make good on our debts. Is there any sense here, based on what we learned from Moody's on Friday, that there's sort of any real crack in that faith?
Well, I think what Moody's was expressing was a concern of how high our deficits are getting, and that the Congress is about to pass a tax cut, or at least seems on track to pass a tax cut that makes it substantially worse, even in a relatively a good economy, and that's really the concern. So right now, investors still seem to have faith that we'll figure out ways to meet these deficits, but it's certainly unusual. To have persistent deficits like this again in good economic times, and so that has to raise a question for any economy.
One question that was raised when I saw this on Friday was the idea that whether this would sort of be ammunition for some of those really fiscally conservative Republicans who have been looking for years to address the deficit and address debt levels. They had an opportunity to do that, and at least based on what we know right now, they've pretty much caved, and it does look like this tax bill is on its way to being passed by the House of Representatives. What is the threshold? What is the impetus? What is the catalyst where we would actually see a Congress actually push back on these types of spending measures in the face of some of these GDP and debt ratio and deficit ratios that we're taking a look at now?
I mean, it's a great question because they certainly did talk a really big game, and then it does appear that when it came down to either not continuing to reduce revenue even further, or cut spending, they've just not a lot of appetite for it right now, and it does seem like they're gonna, be willing to sign off on things that, again, as you mentioned, does substantially add. My guess is, unfortunately, it's going to take a larger signal from the market than this. We have seen the bond market, have some jitters this year in and around these issues, but we really haven't seen kind of a real accident or signal, if you will, that is enough to get Washington policymakers to change their perspective and make, be willing to make some difficult choices.
Yeah, well, that's been the case for decades now. Sarah, you served as Deputy U.S. Trade Representative from 2021 to 2024. You oversaw some critical trading relationships across Asia and Africa. How often did the topic of treasuries and other countries buying treasuries come up in negotiations? Is that something that is discussed directly?
Not typically. I think we've been in a very enviable position where it's just a good deal for countries and a good steady place to put resources, and so you don't really even almost have to have the conversation. But we are obviously getting to a point where, again, we're going to add even significantly more, and it's not because of, COVID, where the government had to largely shut the economy down, or crises. Of course, you expect it during then. These are, again, normal economic times, and I think that is also what is making these creditors nervous.
No, I agree, and I'm glad you bring that up. I wonder, because as a practical matter, does the loss of the last AAA credit rating actually mean that some countries or some central banks would be less inclined to buy treasuries at all? Or as long as it's investment grade, the highest rating overall within that band, it's not an issue?
Well, I mean, it's certainly going to make everybody look at things again. But as you mentioned, this is not the first rating agency to make this choice. I don't know in that regard that it's telling these countries anything they already didn't know. But it should serve as a cautionary reminder to all of us that this is not a sustainable way to run our debt and our deficits, and at some point it's going to catch up with us. I don't know if this will be the moment, but we're certainly, in a more precarious position given this.
All right, Sarah, thank you so much. Sarah Bianchi is Chief Strategist of International Political Affairs and Public Policy over at Evercore ISI. And again, this is yet another administration that's done this, but as Moody's has pointed out, these are successive presidential administrations that have basically allowed the deficit and the debt burden to increase.
Well, and I don't really even put this on the presidents. I mean, this is Congress's job.
Yeah.
And I mean, and I really mean that. And I'm not trying to make a political statement here. It's easy to say, oh, Trump did this, or Biden did that, or Obama did this. At the end of the day, the Constitution makes it very clear who's supposed to be doing this, and it's the folks in Congress. Speaker Johnson isn't doing it. The previous speaker didn't do it. The previous speaker before that didn't do it. And we could probably go back to before we were born, Scarlett, and you can see the long list of failures in our U.S. Congress.
Well, these are people who need to get reelected, right? That's what they would say. So,
and I'm sure they will by promising, the next big shiny object instead of dealing with the hard truths. All right, when we come back, we're going to set you up for what could potentially move the market over the next 24 hours, and that includes some really interesting earnings, including from Home Depot. Stick with us. This is The Close on Bloomberg.
All right, Home Depot reports earnings tomorrow, kicking off a week of retail results. Investors keeping an eye on the retailer's exposure to tariffs, of course, and the potential for consumers pulling back. Joining us now to discuss this, Bloomberg's Jaewon Kang, who covers the company. And Jaewon, I think a lot of that will be encapsulated in what Home Depot says about comparable sales, same-store sales. What's the trend there like?
Yeah, so Home Depot's comp sales are estimated to turn slightly negative for the quarter. And as a reminder, that metric had been in the red for about 2 years and just turned positive during the previous quarter. So I think investors are going into tomorrow expecting softer numbers. The start of the year has been a bit slower than expected, and consumer sentiment, in addition to home builder sentiment, have really taken a hit in recent weeks from uncertainties caused by tariffs.
I am curious, when we get those numbers, and more importantly, some of the commentary, are we just going to hear about, I guess, the economic conditions that might be weighing on the company? Is there also a direct tariff impact?
Yeah, so I mean, Home Depot and other, home-focused retailers, they've been trying to navigate through this, slow housing market for a few years now. Interest rates have been really high, and that's pushed people to stay on the sidelines when it comes to moving homes or pursuing housing projects, and that's still the backdrop. And what they also have to deal with now is, of course, tariffs, and prices of goods are expected to rise. Some of those costs will, flow through to consumers. So the big question now, I think, is, which items are going to get more expensive, by how much, and, to what extent that hurts demand for the sector that's already been under a lot of pressure.
And of course, the housing market as a whole under pressure in the U.S. because of affordability issues. How does that play into Home Depot's results? What's the correlation between housing prices and mortgage rates and Home Depot sales?
Yeah, so with interest rates staying really high, people are not really, as willing to move homes or, try out projects that typically need financing. So that's really slowed business for them over the last 2 years. It's not just Home Depot, Lowe's, they've talked about the same thing. And just, generally discretionary spending has been hurt quite a bit. So, we expect to hear more color on that tomorrow as well.
All right, Jaewon Kang is going to be all over that. Those Home Depot earnings out in the morning here. Comp sales expected to be down on a year-over-year basis, and total revenue, we should point out, it's going to be dropping, if you believe analyst estimates, for a fifth straight quarter. All right, let's take a look at some of the other things that could potentially move the markets over the next 24 hours, and that includes some earnings out of quite a few other companies. A bit of a hodgepodge here, Scarlett.
Yeah, you've got Viking Holdings, which is the cruise company, Amerisports, which manufactures sporting goods and sporting apparel, and then you've got Palo Alto Networks, the cybersecurity company, the big one. So that should be really interesting because it will set the tone for the others in the industry.
We're also going to get more Fed speak if you didn't get enough today. Bostic, who spoke today, going to speak again tomorrow. Bark and Collins Hammock also on deck.
As well as Daly. Let's just add that one, too.
Yeah, why not? Why don't they all just speak every day? Why not? Anyway, you know who's speaking? Elon Musk, the 5th Qatar Economic Forum opening in Doha. And Sir Elon Musk is going to be speaking.
Did you just give him a title?
I did.
Sir Elon Musk?
Yes.
Huh.
G7 finance ministers and central bank governors
I'll leave it at that.
meeting in Canada as well. And Secretary of State Marco Rubio, no sir there, set to testify for the Senate Foreign Relations Committee. Did I just stun you, Scarlett?
I did. Yeah, you did. I'm still
speechless.
just trying to recover from that, Sir Elon Musk. Wow.
All right. Well, on behalf of myself and Dame Scarlett Fu, we thank you for joining us here on The Close. Stick around. Their team at Balance of Power is coming up next for all your political coverage. That starts at the top of the hour right here on Bloomberg.
No titles there?